whether it's trade or geopolitics or supply and demand. There is so much in focus on the ground here in Vienna as we see the OPEC ministers and also plenty of others inside the OPEC group and the periphery of the OPEC group descending on Hofburg Palace here to have a conversation about exactly what's happening in the second half of the year and, of course, all of these issues as well. So let me bring in your next guest here on Squawk. Very pleased to say that Bob McNally joins me now from Rapidan Energy. Bob, it's great to see you. Welcome to the program.
Great to be here in balmy Vienna with you, Dan.
Yeah, balmy's the right word, I think. Very chilly outside, yes. Bob. You've been doing this for a long time, so help me understand what is going to happen over the next couple of days here. And ultimately, Bob, what do you see as being behind this decision to ramp up output from the OPEC group, particularly in this environment? What's behind that move and why now?
Yeah, Dan, thanks for having me on. So this conference is great, and we're going to talk about the long-term alleviating energy policy, the end of the decade. Is demand for oil and gas really going to peak and collapse? But then the short term, as you mentioned, there's an interesting divergence. Reasonable people can differ about where fundamentals in oil is going later this decade. And I think OPEC Plus's decision, or the group of 8 volunteers' decision, to accelerate that tapering from 411 KBD to 538 KBD is sort of OPEC Plus putting their barrels where their mouth is. In other words, they see a tight market continuing into the second half of this year. They have demand growth year on year well over 1 million barrels a day. I think OPEC has about 1.3. And they're cautious on non-OPEC Plus supply growth, the U.S., Brazil, et cetera. So if you believe that, then the market needs more OPEC barrels, and OPEC is supplying them, Saudi Arabia and UAE particularly. There are those of us who are a little more cautious. No question. When you look out the window at the visible data, the market's tight. Cushing is about empty. Diesel inventories, especially in the United States, quite low. Curves for crude oil are backwardated. So it's a tight market. This is all about the second half, though. Partly it's a macroeconomic call. We're in unusual, if not unprecedented, macroeconomic times. Black swans aplenty, particularly with regard to tariffs and interest rates and so forth. And also there's a reasonable difference of opinion over how fast supply from Guyana, Brazil, Argentina, Canada will grow. We tend to think that we're going to enter a soft patch here in the second half of the year. But by no means do I have a monopoly on wisdom there, and reasonable people can differ.
So you're more bearish than bullish for the second half. Elaborate on that for me. What is that going to mean for prices? Because we're trading at around this 70 USD handle right now. Is it reasonable to expect that we will see a 5 handle, as some have suggested, on the price of oil before the end of this year, Bob?
I think so. We forecast Brent falling into the mid-50s range. We think the contango that now exists at the sort of back end of the Brent curve is going to roll up to the front. We think we're going to see builds in visible inventories. We think inventories are building in the second quarter in less visible parts of the non-OECD, China and so forth, at sea. But in our view, you're going to start to see softness materialize in the front of the curve, the front of the market, and you'll see spot prices come off. That's our view.
Okay, so what is that going to mean for investment into this industry? Over in the United States, the president's talking about drill, baby, drill. Giovanni Stranovo at UBS told me today maybe it's more like chill, baby, chill in this environment. But on the other side, you also have OPEC adding barrels, and they are really validated by what they're seeing on the demand side right now, yes?
Yeah, that's right. No, that's right. So far, they are validated. When I talk to our clients who are thinking about making long-term investments in energy and oil and gas, less important are the gyrations day to day. The shale patch, Texas, is none too pleased about $50 oil or lower. They don't like that message at all. However, in my view, a bigger dampener on investment is this consensus, this persistent consensus that developed about 4 or 5 years ago, that global oil demand and global gas demand is on track to decouple from GDP, fall, and peak by 2030, with the debate being whether it plateaus or collapses thereafter. It's that medium to longer term demand outlook which is the bigger sort of bummer, if you will, for those thinking about investments in oil.
Talk to me about the biggest black swan that you see in this market right now as well, because it's been suggested to me that the geopolitics is still a clear concern here. Yes, there was no immediate impact on supply through the Israel-Iran conflict, but at the same time, the Iranian foreign minister writing an op-ed for the Financial Times in the last 24 hours saying Iran will not be pushed back to the nuclear negotiation table with the United States and will not negotiate under threat. Do you think markets might be underpricing the risk of another Middle Eastern flare-up?
You know, I think they are, and geopolitics is by far the biggest black swan near term. What comes after, though, would be macroeconomic risk, particularly from the United States. But, you know, the market understandably has been shrugging off these false alarms. We've been getting them since late 2019, September, when the Iranians attacked Abqaiq, the Russian invasion of Ukraine, $127. We've been falling ever since. Israeli-Iranian flare-ups and a mini war, only a brief spike. So it's understandable. I don't want to be too dismissive or critical of the market's skepticism. However, as you pointed out, we are not out of the woods with Iran. What we believe in here is that the last 20 years of just sort of kicking the can down the road with Iran is likely to come to an end. We are heading to where we're going to have either a diplomatic deal, lifting of sanctions, and a more benign scenario, or I think we're just setting up for the next round of conflict, especially if Iran attempts to go for a bomb or refuses to negotiate or even reconstitute its sort of shattered air defense system. So we are not out of the woods yet.
I've been saying for a while that the Middle East doesn't really do clean exits. It kind of just does cycles, escalation to de-escalation and beyond. What's the next flashpoint we should be watching then?
Well, the next flashpoint will be whether or not we can get to a deal or a negotiation with Iran. So far, President Trump has backed off of this maximum pressure. We've been increasing our estimate of Iranian exports. We had assumed President Trump would sort of crack down, but he's very nervous about oil prices. This is why you see an easier policy with regard to Russia oil sanctions and now Iran. But I think they're going to give talks a chance. The president, he's perhaps the only president who would have ordered a preemptive strike on Iran, but he's also the only president who would do a deal, even with this regime, with Iran. And so the biggest flashpoint is whether we get into a deal dynamic, whether the Iranians feel desperate enough, despite their bluster, to come to their senses and do a deal, in which case things could get quite bearish, or with Israel impatient to prevent Iran from sort of recovering and resuming its activities, and President Trump unwilling to accept a nuclear-capable Iran, whether we cycle into another round of conflict. That is probably the biggest question facing oil markets near term on the geopolitical front.